Maybe the, okay.
Or maybe you make me host, and then I can do it too. I don't know.
It works. Yeah.
Oh, it's already on now.
Now it's on, yeah.
Okay, well, then good evening in Shanghai, good afternoon in Europe, and good morning in the United States. We have today Friday, 21 April 2023, and we are summoning ourselves, so we're here to celebrate LPFMI and a half-day webinar introduction series into research in the field. We just had just an hour before a kickoff with a review of last year's event, and now we're going to start off with now we're going to move into research. And David, what he's going to do is he's going to prepare the ground for his interaction in June, and going to talk about China's development strategy and sort of emerging market currencies as a vehicle for development financing. And before I hand that over, I'm going to quickly introduce our two presenters or interactors for this session. We have one presenter and then one discussant. So I'm going to start in introducing the presenter, who is known to LPFMI fans or researchers due to his interactions last year in spring, which was the end of May 2022. So I'm going to now introduce Cher, and here I'm going to read out. So David is currently working at the research department at the New Development Bank in Shanghai. And before that, he was a part-time economist at the IMF China office. David holds a PhD in economics and a Master of Management from Tsinghua University in Beijing, and a Bachelor in Economics and a Bachelor in Statistics from Beida University or Peking University. He was also an inaugural member of the Schwarzman Scholar class on campus of Tsinghua University, sort of a policy school between the United States and China. And his research interests cover industrial upgrading of developing countries, development financing, and economics of infrastructure events. And I think with that, actually, I'll hand it over to you, David, and I will introduce Sasha then when it's his turn. So thank you for being here, and over to you.
Great, thank you, Kiko. Does everyone can see the screen that I'm sharing?
Yep.
Yes. Okay, great. Thank you very much, Kiko. Thank you, Sasha. Thanks everyone for participating in this event. I'm gonna be really quick because I think that I don't call myself as a researcher by this time because I'm overwhelmed with all the kind of routine daily work. But I just want to provide some of the background about China's post 20th National People's Congress of the CPC, this development strategy. And I also want to provide some of my very initial thoughts on how development financing can be further enhanced with emerging market currencies. So without further ado, let me first start with the first part. So before directly diving into post-CPC 20th Congress development strategy, I want to have a little bit of a review about China's overall development strategy since the 1980s. So if you see here in 1987, we actually proposed the well-known 3 steps. The first is in 1990, we will achieve sufficient food and clothing for the people. So nobody will be starved, nobody will suffer from the coldness. And then in 2000, we will achieve a moderately prosperous society, in Chinese, 小康. And then finally in 2050, which is 50 years from that time, So the per capita GDP will become the level of a developed country, a medium level of developed countries, and achieve modernization, finally achieve modernization. So this is pictured in 1987. And then in 2000, in year 2000, so we should have been achieving a moderately prosperous society. But at that time, the leadership decided there are still many flaws in the Chinese economy, in people's life. So it will be a little bit humiliating to pretend that we have achieved what a moderately prosperous society means to the common people. So they say, okay, we have achieved only in general the moderately prosperous society, and we will achieve an overall moderately prosperous societies in all aspects in year 2020. So this further divides the 50 years from 2000 to 2050 into two parts. One is 2000 to 2020, and then 2020 to 2050. Now let's come to another proposal 5 years or 6 years ago in 2017, is divided the 2020 to 2050 part, again, into two parts. The first part is 2020 to 2035, which we will achieve basic modernization, which means, as you can see, we are preloading, front-loading, achieving modernization to 2035, so 15 years earlier. And then in 2015, we will build a great modernized country. Now we come to the latest proposal in 2022. That is, we divided the road from 2020 to 2035 further into two parts. The first is from 2023 to 2027, and then later. So in 2023 to 2027, we will make progress in high quality development and create a new pattern of development. And what will be done by 2035 is that the per capita GDP will reach the median level of a developed country and many other things. So I guess I want to set the big picture about where China has been and where China is headed towards in terms of development strategies. So I call it from two steps, the initial two steps, to many two steps in later time. Okay, so I guess one of the key words from President Xi's political report to the 20th Congress is a Chinese path to modernization. In Chinese, 中国式现代化, right? I guess you have been hearing a lot about this, but what is really unique for the Chinese path? So President Xi himself summarized that in 5 aspects. The first is the modernization of a huge population, meaning that out of 1.4 billion people, a country of that size, an economy of that size, to achieve modernization is something unique. And then is a common prosperity across this huge 1.4 billion population. So it's not the wealth of the top 2% or 10% or 20% that lifting the average of per capita GDP. No, we should lift the bottom to a certain level so that we achieve common prosperity. The third is that we want to achieve cultural and ethical advancement in due course. So we need buildings, we need cars, but we also need some spiritual life, which I think is very interesting to see, because usually when you think about the modernization, it's just about the material life. But in President Xi's eyes, he's putting cultural and ethical aspects to the Chinese path of modernization. And also the fourth aspect is the modernization with the harmony between humanity and nature. And I guess this leads naturally to carbon neutrality, to environmental protection. And last but not least is China will stick to peaceful development as long as the sovereignty of the country is not compromised. So this is the biggest, they call it the biggest theoretical breakthrough of the political report of the 20th CPC National Congress, is to formally put forward the theory about a Chinese path to modernization. I won't call it a theory that seriously, but I think it's ringing the bells to see where China is headed towards. Okay, Another very controversial part about China is whether China still values development and especially economic growth. I think there has been a lot of discussion among this topic. I want to bring a few points for your attention. The first, I believe, is that reports reaffirm that development is still job number one, because the part discussing development remains the fourth section of the overall report. The first section is about previous achievements. Second is about the guiding principles for future works. The third is about the overall mission for the next 5 years. The fourth part is about development. So I think this is still valued. And to quote from the report, to build a modern socialist country in all aspects, we must first and foremost pursue high quality development. So this is the point I want to make. And also, economic growth per se is still valued as a top priority. The report says that sustainably grow the per capita GDP to be on par with a mid-level developed country is the job to be pursued by 2035. And if you recalculate that compared with today's China's GDP per capita level, you will get a rough picture about China's potential growth rate in the next 15 or 13 or 14 years. So for this, you can do various calculations. You can have various definitions about what qualifies a per capita GDP of the medium level high income economies. I did some very rough calculations. We can come back to this later. My rule of thumb is that China at least needs to grow per annum 5%, at least 5% to be qualified as realizing this goal. So this is still a very hard job, considering during the COVID-19 China growth rate slided a lot. Is although compared to other countries still good, but the absolute level, the absolute goal of this still requires a lot of effort. Okay, the next part I want to talk about is high quality development. What is high quality development? What does it mean? It has been talking a lot. China should not just expand the economic size, but to pursue a high quality development. I want to summarize very quickly a few points here. The first is that the high quality development emphasizes on the real economy and the industrial system. And people have been discussing a lot about the role of the services economy, and that for a country to be advanced, it needs to constantly develop the services economy. That's still true. But in this political report, it's especially featuring that pursuing the real economic growth is very important. But here, the real economic is not just talking about the industrial sector, the production of steel and coal. If you see from the report, aerospace development, transportation, cyberspace development, the digital economy, all these things are also considered to be linked very closely to the development of the real economy. And it also features that the integration of the modern services with advanced manufacturing, the IoTs, the logistics sectors, these are all discussed in the part of the real economy. Okay, the second thing is that the emphasis on innovation, on science and education. Very interestingly, these topics used to be scattering around different sections of the political reports. However, in 2022's report, these has been combined into a new section, put just below the section on development. So this, you can see how the leadership is valuing innovation, science, and talents. So they discuss this as a primary productive force, a primary source, and a primary driver of economic growth. So this is the second point I want to make. The third is that the emphasis on high quality, high standard opening up. There has been a lot of discussion about the dual circulation. I guess last year I also briefly touched upon the project, but if you look at the report, it still says to amplify the interplay between domestic and international markets to improve the quality of trade and investment and cooperation. But under this, what can be done? The report says we need to expand institutional opening up. So not just opening the market, but you need to align the rules, the regulations, the management standards to international standards. This is why I believe China has initiated the talks with CPTPP, with DAPA, with all the other like high-level trade treaties or agreements that many countries are currently seeing China has a much long way to go to reach their standards. But when you think about it, when China joined the WTO, there's also a big gap between China and the requirement of the WTO. But as long as you have the political view to push forward for reforms, I think China can still achieve something there. And here in this part, the report mentioned promoting the internationalization of RMB in an orderly way. So the China regards the currency internationalization as part of its work to achieve high quality opening up. And then emphasis on green development is also reaffirmed, but here is more emphasizing working actively but prudently towards the goal. So this is to address last year in 2022, many provinces are trying to have a leap forward, a big leap forward to achieve green development that hurt the production of energy, for example. And now the leadership has been saying that, just put it slowly, put it gradually. This will also have a very large implication for the energy sector, which we can get back to discuss later. Okay, and then it's the emphasis on the coordinated and shared development. So this we're focusing on the rural development. We're focusing on regional development of less developed areas, especially about the livelihood, the personal income, the public services such as social securities, about medical services, about nursing services for the elderly, and also try to further expand the size of the middle income group. Currently, China have about 400 million middle income group, and by 2035, China aims to expand it to 800 million. So we'll double the size, which I guess will have a very profound implication to the overall landscape of the Chinese economy. Okay, sorry I've been rushing through the first part. I want to leave some time because I learned from Kiko, this is what everybody here are experts of, and we have a larger interest. But I have to be very honest, I'm just providing some of the very initial thoughts for your discussion, for your comments, for even your criticism. So let's first start by giving a few observations. So first, we all know that US policy rates has been rising very rapidly in the past year. And we have all been discussing a lot about this, and it has been pushing long-term bond yields, although not to that level, a high level as the short-term ones. But still, you see, although many people are betting on fast cutting interest rate in 2023 or 2024, the question I want to ask is, given that the current level of the federal funds rate are not the highest in history, how low can it be in the next cutting cycle? Especially given that the Fed is trying to defend its reputation in containing inflation. So I would say my initial guess is that even if there's a cutting next year or late this year, I don't believe we're going to go back to the ultra low levels seen during the pandemic. So at that time, the long-term, short-term yields is zero. But you see from this chart I obtained from the St. Louis Fed, that in average term, in the previous average of the years, federal funds rate has been much higher, as high as about more than 5% during even before the 2008 financial crisis. And even you talk about the low area here, about 2002 to 2004, it's still higher to about 2%. So if we cannot go back to the ultra low levels of interest rate, we would have to accept that many of the emerging market institutions, when they are raising hard currency financing, they will have to face a higher cost than what they have observed in the past 3 years or even in the past 10 years. Okay, so this has already been the case. In this figure, I'm showing for India Exim Bank, the yield curve of its US dollar bond. You see the orange line is the yield curve in 2021 in Q3 by the end of the third quarter. So C is rising, but it's of a much lower level compared with a year later, the blue line. So in all the maturities, India Exim Bank is facing a much higher US dollar funding cost in the international market. The same can be said for China Exim Bank. These are the two very important developing institutions, development financing institutions in the two countries, in China and India. And usually you see they want to obtain hard currency financing because many of the firms are needing them for trade. And because they are offering a lower financing cost, especially for India, right? This is the policy rate. The policy rate is much higher than in China, so that if you raise US dollar, if you raise money in euro, you will have a lower funding cost. But that has been changing. This leads to my next figure. So this compares the yield spread between local currency financing and hard currency financing. So you see before in the orange line in the left panel is that India Exim Bank usually enjoys 3 percentage points cheaper for its USD financing cost compared with its INR Indian rupee financing cost. But now the benefits of USD finance has been shrinking as the USD funding cost is constantly rising. For China Exim Bank in the right panel, it's even more. This point is even more important because before RMB financing is more expensive than USD financing for China Exim Bank. Now it's the opposite. RMB financing is cheaper because China has been having a losing or easing monetary policies in the past year. So although these things may not last as the US continue to adjust or shift its monetary policies in the future, but this rings a very important alarm, is that the lower interest rate cost for your hard currency financing may not always be there, even for the most established developed financing institutions in China and in India. So then what? I'm saying that if, for example, for the China Exim Bank, if RMB financing is having a lower cost, then maybe we should switch back to emerging market currencies to at least partially financing the development. Although there are still many other discussions, I think this could be a possible lead, a possible move, given that we have having a lot of discussion within our institutions. However, I would have to say not all the currencies will qualify for development financing around the world across the countries. Here, I want to put 4 criteria about what kind of currencies can be the good candidates to further enlarging development financing in emerging markets. The first is that it needs to have a low treasury yield, right? Because this is what we are looking for. You cannot have a 10% policy rate and then to service as emerging market development financing, because infrastructure projects will not be sustainable if you have such a high financing cost. The second is that you need to have a stable foreign exchange dynamics, and ideally, the bilateral exchange rate between this currency and other emerging market currencies should be more stable compared with the US dollar, meaning that when the US dollar is unilaterally appreciating, this currency will not appreciate that much, which will be a relieving factor for foreign exchange exposures for other emerging markets who are borrowing in these emerging market currencies. The third point I want to raise is that this currency needs to have a relatively wide usages in the international transactions. Otherwise, you got this currency, you have nowhere to use. You cannot exchange it easily into other hard currencies. You cannot use it to purchase goods and services, and you cannot use it to invest easily into bonds, into high safety securities. It will be a disaster, right? It will be very low efficiency. And last but not least, it needs to have a very large bond market. because most of the development financing today are still relying on issuing bonds in a market-based practices. So these are the 4 criteria on what I want to raise. What I'm not saying in the slides, but implying is that RMB naturally fits in here. Many people are asking, Indian rupee will have a large role to play. The Russian ruble will have a large role to play. Brazilian real will have a large role to play. I agree with them all, but it seems like from the market practices, from the market perspectives, now RMB have a little bit of a comparative advantages when you're looking at these 4 criteria. How? The first is that China's yield is quite low. Right, China's if you look at 10-year China's government bond (CGB), the yield is around 4% in the past 10 years, and it has been very stable. This will provide a solid base for lower funding cost. The second is that since the foreign exchange reform in 2016, China has been pegging a basket of currencies. Many of them are emerging market currencies, and its exchange rate, bilateral exchange rate with Indian rupee, with Brazilian real, has been very stable, even more stable compared with the bilateral exchange rate between the US dollar and Indian rupee, and US dollar and the Brazilian real. And third is that China, the RMB, is the only emerging market currency in the IMF SDR basket, have a relatively wider usage internationally compared with other emerging market currencies. And this is guaranteed by China's commitment to the IMF. For example, every country can use RMB without hindrances or obstacles to address balance of payment issues. And also all the central banks and their affiliated investment funds can enter China's foreign exchange market freely to do swaps, to do exchanges. So this is a commitment to the SDR basket. The last, in the China's bond market, if you look at data, the China's fixed income outstanding amount, I guess by far is about 13%, at least 13% of the world total. And in the past year has been rising constantly. And many of them are, the project bond, infrastructure project bonds, so that Chinese investors already have a taste in investing in securities related to infrastructure investment. But what I want to mention is that recently we have seen a lot of news about the role of emerging market currencies globally. We have been talking about the China-Brazil trade with RMB. We're talking about China-Russia trade with rubles. We talk about Indian-Russian trade with rupee and ruble. And ASEAN, I guess 2 weeks ago, during their minister discussion, they are calling for you relying more on their own currencies instead of hard currencies to do trade. And then, for Middle East and China are also trying to do RMB purchasing of LNG, of oil, of other things. But I want to say, we're going to see in 5 years or in 3 years a very interesting phenomenon. Is that instead of another unilateral or a unipolar international monetary system as in the past 30 or even 70 years, we may see a multipolar international monetary system. Because in this cycle, the driving forces are very different. First is that previously the international monetary system is driven by efficiency. You're relying on one currency, one network. That's the most efficient. You cannot deny that. However, in this round, it's about resilience. We want to have a second choice, a backup offer, even if I'm facing difficulties in one system. So this naturally leads to 2, 3, or even 4 system that we can choose from. We can have a backup. The second is that previously, especially after the 1980s, internationalization has been driven by finance. If you look at today's banking networks or even the monetary networks of the SWIFT, it's centered around different banks. I guess Kiko is an expert here. We have correspondence banks opening up accounts across each other's systems. You have to do layer by layer, and everything there will be linked to the system of the United States for dollar transactions in the internal system. So this is about finance. However, in this round, I guess it's more about real economy driven, about trade, about purchasing energy, purchasing iron ore, purchasing other bronze ore. These things, they will care less about finance. They will care less about stability, about how to get the deal done. Okay, and the third one, the very last one, is that previously, because it's finance driven, it's efficiency driven, it's most actors are private firms. We'll look at the multilateral, multinational firms. Most of them are private firms. They are pushing forward the internationalization of a currency, of the US dollar, of a monetary system. But now, I guess, because we're seeking resilience, because each country wants to have a backup, we will see more and more state-driven efforts to try to set up a new monetary system. So I guess these are very important implications for the future. And then various arrangements they will compete with each other. There might be some winners, some losers, but I guess in the next 10 years, we will see the competition among different, because for market participants, they will have their own choices based on efficiency, based on stability, based on who are using them in the end. Okay, so let me go to my very last slide. Is that what are the role about multilateral institutions in this process? Many have been talking about RMB internationalization pushing forward by China Exim Bank, about China Development Bank, but I'm saying that we should focusing on enlarging the role of multilateral institutions for this. For example, let's consider an MDBX. I'm not going to quote MDB because of compliance issues, right? So it's a multilateral development bank set up by 5 countries, A, B, D, E, and China, and it's located in a Chinese city. So you can just think about this as the BRICS Bank, right? Founded by the BRICS countries with equal shareholding and located in China, in Shanghai, in the financial center. So, and then you can think about this when you have firms from A, B, D, E, you have foreign firms from China, they want to borrow RMB. Now that you have 2 options to process this. One is that the development financing institutions or financing institutions in country A, B, D, E issue bonds in China. This is way one. The second way is that MDBX will issue bonds in China and then lend it to the development financing or financing institutions in other countries. It seems that the latter role, have taking a second layer. But I'm calling that there might be something valuable in this process. Think about this, the financial costs. When you have an Indian institution issuing bonds directly in China, Chinese investors may be very reluctant because they don't know about whether this is a good firm from India or it's a bad firm from India. Or think about it, they know Brazilian firms such as the Valley, but they may not know a private sector firm catering to the services in Brazil. So in this time, if they want to raise directly, they want to access the China bond market, the China interbank bond market, they might have a very high risk premium perceived by the Chinese investors. However, if the MDB is located in China, with strong support from the Chinese government, with leaders visiting this bank every day, Chinese investors might say, okay, I know this institution is my neighbor. I should trust its ability to pay it back. It will possibly assign a lower risk premium to this MDB located in China, which means that this MDB will be able to, on lending the proceeds they got to development finance institutions in India, in Brazil. And then these financing institutions, they know their customers in their domestic country. They will say, this is a very good Indian economy, a very good Brazilian economy. I want to take this risk to lend it to this institution at a very low cost. So in the end, possibly you will find, if you use the MDB approach, you will possibly have a lower funding cost. Okay, this is my first point. The second is about the debt trap acquisition. We've been hearing this a lot. Many scholars are actually writing that this is a fantasy. But when you are over borrowing from a Chinese institution which has a close relationship with the government, there will definitely be this kind of accusations or speculations. However, if now you are borrowing from an MDB, which your country have 20% equities, equal equities with other member countries, with a vice president in the senior management, you might have a better feeling. You might have a better, I will call it a sense of control, right? Because you are on this, you are on the board of this MDB. You assign governance to this MDB, and together with other countries, you can block the unreasonable requirement from China in the future. So I think this will, from the borrowing perspective, MDB approaches have some comparative advantages. And from the investment aspects, I guess similar stories can be told. Think about if now a foreign institute or foreign firm has a hands full of RMBs and wants to invest in safe securities denominated in RMBs. It can invest in China sovereign bonds, China government bonds. It can also invest in the RMB bonds issued by this MDB. I guess the first comparative advantage is risk diversification. When you invest only in the Chinese sovereign bonds, you have a concentration risk. If you can split this into half Chinese sovereign bond, half MDB bonds denominated in RMB, you have your risk diversifying into two institutions. So I guess this will give an improvement to the portfolio. Second, again, is a sense of control. If you only invest in CGB, in China government bonds, then China will just be a new United States, right? Someday people are going to ask whether China will act irresponsibility as the new US Treasury overflooding the world economy when you are good, and tightening the policy rates when you're in trouble, having spillover effects to other economies, right? People are gonna ask that questions. So if you can invest not only in China government bonds, but also in multilateral development institutions bonds, because you assign board of directors, you assign senior management, and you have a very large share of equity, you might feel better. You might have a sense of control. So this is, I would say, a lot of work needs to be done. There needs to be institutional reforms to facilitate this to happen. But more importantly, both China and global practitioners might have to change their mindsets to value the multilateral approaches, to evaluate the contribution it can do in the future. Okay, this is what I want to talk about. Thank you very much for your time, and welcome your comments, your criticism, and discussion. Thank you very much.
Thank you, David. It was fantastic. Thank you for coming out this night Shanghai time. I have to say I appreciated your contribution to the overall conversation, because it's a bit of coming out of the developing country and in China, and then you don't have to rely on Western sources. This is directly from the source. So this was much appreciated. I should have maybe added to your introduction when I said that you are an economist at the New Development Bank, that the New Development Bank, for those who don't know, is a multilateral development bank in Shanghai from the BRICS countries. I think maybe everybody knows that, but I just wanted to make sure. And so you are in a very interesting position, obviously, sitting in this 5-country, and I think by now there's some 5 additional countries have been also added. So there's some, it's sort of the global South or developing countries, a multilateral institution. So this is, has been very interesting. I'm going to hand it over now to Sasha and then see if we have some time left for questions. And Sasha doesn't need much of an introduction around in these circles, but nonetheless, he has a PhD in law at New York University in Shanghai. So that's another Eastern source talking to us. And his current interests are, or research focuses on China's macroeconomic policy, money market, and real estate. And with this, Sasha, I hand it over to you.
Hi guys, do you hear me okay?
Yes.
Thanks. David, if you could go to your slide 23, I think it's the 23, so one before the last one you had, it would be good for me. It would be easier to pick up. So yes, this is the one. So thanks, David. This was really good and very interesting to hear, especially in the context of this RMB internationalization and kind of discussions that have been going on around it. And then we had some quite interesting discussions within YSI around this with Zoltan Požar and Perry also pitched in and several other people. And there was a lot of skepticism around prospects for that. So it's very interesting to hear from you something which would be kind of picturing the way it could in fact work out, right? Well, I have been interested in the arguments why it could work out. I thought this skepticism was often maybe somewhat coming from somewhat conservative intellectual standpoint, while maybe we should be more open to it. And as Zoltan would repeat in these conversations, it's like in the initial stage, right? In the stage of this nascency, things appear small, but once they take off quite fast, and we see these changes. Now, okay, what I'm going to try to do just in a couple of words here is to be the devil's advocate and to repeat some of these arguments that we have heard at the time on why this wouldn't work potentially, right? So I guess the main thing, right, that is said in these circles is that in fact, if you were to have even a transition towards a kind of a multi-currency world, if not a switch from one dominant currency to another, you would need to look into the ways in which that happened in history. And if you look at the way in which that happened with pound, in fact, it was really the Second World War, the deep problems in the international payments that Britain was facing, was servicing its debt to the US, and then the renegotiation of the international currency system that happened afterwards. What is usually implied when this is brought up is that, in fact, it is very, very hard to contest a dominance of a currency internationally, simply because once the system is set up and the participants are using it and reproducing it, there is almost no benefit. The benefits for them of switching out or diversifying are rather meager and usually not enough, and often, in fact, such that it is much more useful for them to stay with the dominant currency, whatever they are doing. And now, if we try to kind of bring this argument into the context of what you were saying, I guess the main two things that would be brought up is access, for example, to the Chinese bond market, right? And general capacity of RMB holdings, whether domestic or foreign, to move from the mainland, to move cross-border, right? And we know that, of course, this has been improved in terms of like all of these schemes that have been set up over the last 10 years or so. And obviously it is much better than it used to be, but still we know that this, even today, is a very, very constrained and conditioned channel, which does not allow, in any case, for investors and traders to seize certain opportunities that they have as long as they are operating, for example, in the Eurodollar system, right? One thing we can mention here simply is the speed with which you can move in and out of currencies, through the Eurodollar system, and whether we think of Swiss franc or pound or whatever. This obviously you cannot do through the Connect or through any of these institutional investor schemes that we have with the mainland. So that would be a big kind of risk to take potentially for anyone who would want to hold any of these either securities or just deposits in China, as they would not have this kind of sense of control over this investment, right? In the same way as they would in other places. The other thing is, I would say, would have to do with the payment system, right? So if this is what constrains RMB as a repository of wealth, what constrains it as a payments in terms of payment is simply that in the conversation between private actors or negotiation between private actors in terms of how are they going to determine the currency in which the trade is the buying or the selling of the goods is going to happen. Rarely the question is who would bring up RMB, right? Who would bring up RMB as an option here, right? Who would find it important and is a good possibility, right? And here, right, one, we have obviously two options. One is that the foreign either importer from China would bring it up, or exporter into China would bring it up, or the domestic Chinese importer or exporter would bring it up, right? So these are basically the four options we have, and the idea is that almost no one of these four would potentially have this interest, precisely because once a currency is already dominant as a means of payment, having that as the means of payment for your own transaction has a lot of benefit, right? Even for the Chinese exporter, right, bringing in the dollar into the mainland, depositing it with the Chinese bank, the banks will be very happy. They're going to get their reserve deposits on that, and so on. And in terms of the foreign, let's say, importer or exporter, here we have this argument, this indicator that is usually considered, which is how long is the circuit before a currency makes it back to the domestic jurisdiction where it is issued, right? And what we have seen in the attempts, at least until now, for example, and this I think is very interesting to have in mind when we think of this trade, energy trade, oil trade in RMB ruble and things like that, is like, even if you get, for example, through this kind of interstate agreements for the currency to be brought out, such as RMB, it makes its way back almost immediately, right? So it does not circulate internationally in the offshore for a long time, because it doesn't serve as a means of payment then between the second party and the third party, and then the third party and the fourth party, and so on. But rather the receiver of the currency almost immediately brings it, exchanges it, in the domestic bank with the domestic central bank, and it flows back, right? So I think these are at least the arguments that are often brought up in this discussion. So maybe it would be interesting to hear your thoughts on that. Although I was very happy to hear someone who can present a coherent vision and kind of advantages of probably internalization of RMB in this context.
Thank you, Professor Sasha. I'm going to have a very quick discussion on the topics brought up by Professor Sasha. Thank you very much for your generous words. Glad you liked my presentation. And I think all the points you raised are very valuable, very to the point. And to be honest, I agree with you. This is something very difficult. As you said, historically, the US dollar replaced the British pounds because the US dollar won, the US win the Second World War and has the dominance around the Britain Woods conferences. So I do agree. A multi-currency system will, even if it's achieved, will be one dominance and many small followers. The one dominance will be the US dollar still, US trade with the Euro area and many, even ASEAN countries trading with the US, even China trading with the US, will still use US dollars. But for third parties, for China trading with ASEAN, China trading with Saudi Arabia, possibly a portion of that could be with the local currencies. So the 2 points you raised. The first is that money moving in and out. I do agree. This relates to capital control. And the conventional thinking is that when you are not having a free capital account, when people cannot move money in and out, it will be very hard to achieve internationalization of a currency. I still agree. I do agree with that, because for the private sector, for if I'm a personal investor, if I'm a firm, if I'm a hedge fund, I would like my money to be accessible very timely, right? However, very recently, Professor Etching Green actually wrote an article and also a paper saying that even in the 1950s, capitals are not free flowing, at least not as today, right? So at that time, a US dollar still achieved. Could you just allow me 1 second? There's someone knocking on my door. Sorry about that. My dinner is coming. Sorry. So Professor Etching Green's point is that, so even if you do not have free capital flow, there still could be achieved a lesser level of internationalization, not as those defined by today's standards, but in previous standards. So as long as it is used mainly for trade, for maybe just a measure of units for a payment. And I believe currently this is on the mindset of many of the Chinese policymakers. So they are still very reluctant to fully open the financial market, because they still regard financial market to be very troublesome, even domestically. So even for domestic financial institutions, there's been a lot of anti-corruption happening. So just to treat these very used to regard as very successful bankers, but they have been conducting corrupt operations. They have been, because they are making money, right? So there will be something unliked by the top leadership. So they are very reluctant to fully open the financial market. That's why I say it will be trade driven. It will be real economy driven. Could be trade, could be development and financing. Invest in infrastructure projects abroad will also brought RMB out. But I agree, the volume will be much smaller compared with financial transactions, compared with wealth management. So this will be a lesser state of internationalization. About the payment system, I still agree. This is like when you are used to drinking one brand of milk. As long as you still do not get sick, as long as you're still there, why you change your brand, right? So it doesn't make sense. But here we're having this opportunity about sanctions. When people are afraid that someday my money could be held by some forces I cannot foresee, I cannot control. So this will give people a little bit more of the edge to pursue another backup, to have at least a portion of their wealth, deposited in the other forces, right? So to align with other forces. And for the concrete payment systems, for example, I know you must have heard about mBridge, the central bank digital currency platform initiated by the BIS Hong Kong Innovation Center, together with the Hong Kong Monetary Authority, with Thailand Central Bank, with the Central Bank of the UAE, and together with the Digital Currency Research Bureau of People's Bank of China. So they're doing a cross CBDC platform. So they're considering how can we link the central bank digital currencies of different countries together seamlessly to conduct transactions in a higher efficiency. So they have been publishing papers, conducting real-time usages, and President Xi Jinping actually literally mentioned this tool when he was giving a speech in Saudi Arabia. So I guess with the digitization, with these kind of new tools, they will, lower the bar, although very little bit, low, but still lowering it a little bit, so that we will have more chances to do this kind of experimentations. That's what I want to say. Thank you very much.
Excellent. Now, let me also take the opportunity to thank you, Sasha, for these excellent comments that you have provided. David, I'm looking at the watch. Are we done?
I can take maybe 5 more minutes. I can take 5 more minutes. Sorry that I'm having another meeting with the Brazilian colleagues later. I'm sorry.
Okay,
sorry about
let's see.
That.
I see that Maya had posted something in there, and maybe I ask her if she has a question in that, and if not, if otherwise anybody else has a question. Maya, can you hear us?
Yes, I can hear.
Do you have a question?
I had a brief question about the risk diversification, actually, that you're mentioning, because I don't see it. Sovereign bonds issuance and MDB issuance are where the same sovereign is actually the biggest shareholder. I don't see that diversification is offered to investor, especially given a scenario of financial crisis within China. When that happens, what prevents investors who would hold on to this supposedly new stable currency, right? Because we wanna have a currency which has a storing value. So that function of money needs to be performed, not just medium of exchange, but unit of account and store of value of the renminbi needs to be maintained. And how do you guarantee that China would not just there is domestic financial crisis or anything of that nature, and maybe there would be different treatment to foreign investors, right? This would be the typical Anna Gelprin story that tells us that when crisis comes, we treat domestic and foreign investors differently, right? And we will try to distribute wealth between these two categories of investors. So why would China not do that in the future? How would countries like Kazakhstan be reassured that that risk diversification is ensured within your plan?
Okay, right. Very nice, very good question. Thank you, Maya. Oh, please, Kiko.
Let me just 2 things. Maya, since I also don't know you, would you mind telling your affiliation?
Yes, I am currently at Nazarbayev University in Astana. I'm originally from North Macedonia, and I have been associated with Moneyview through a different channel. I knew Perry from my affiliation when I was at the law school working with Christine Desan at Harvard Law School. So we had this constitutional law of money approach there. So I know about Perry's work through Christine Desan at Harvard Law School where I did my postdoc. So before I came here.
Perfect. So thank you for that. I think then we leave it at that. I was tempted to maybe batch it together with any other potential question, but I think we're running out of time.
Okay,
so we'll leave it at that, and then over to you, David. Thank you, Maya.
Okay.
David, if you want, you can take the answer.
So I thought okay. I'm going to do that directly. So thank you very much. Very important observation, and I think this is what I discussed about. If you're just replacing China with the United States, doesn't make sense, right? So how can you guarantee China will not be another US in the future? Nobody can guarantee that. Even I cannot, because I don't know in 30 years or 50 years who's going to be the boss, what kind of a president we're going to have. So, but you're still gonna have all the international currencies as long as we do not create an enhanced version of the United Nations. All the currencies we use, all the securities we are holding will, for most of the case, be sovereign. sovereign monetary system, fiat money. So what I mean about diversification is not about diversifying the risk about RMB, but for China sovereigns. I'm comparing two portfolios. One is that is solely with China government bonds. The second is possibly half of that for China government bonds. Another half of that is MDB bonds, for example, NDB bonds issued in RMB. When you think about the NDB, the New Development Bank, it is not dominated by China. China owns 20% of equities. The other 80% are equally shared by the other BRICS countries. And nobody will have a veto power. So as long as 4 of the 5 founding members agree with something, it is approved. So nobody holds the voting power. That's by the agreement, the articles of agreement of this institution. So I'm saying is that if the Treasury of China someday decides that, okay, the bond holding by foreign investors will be invalid, I will not pay that money back. The multilateral development banks, this institution cannot do that because the other 4 countries will say this is a bad idea. We're blocking this, right? China, you cannot do this. You are not dominating this institution. So for investors, if you are to invest in RMB securities, investing solely in China government bonds will give you a perceived higher risks than a portfolio with half of that invested in China sovereign government bonds, half of that invested in the multilateral development institutions bonds with no China's dominance. Although China is a great supporter of these institutions, the president is not China, is not from China currently. The board of governors from the BRICS countries. So these things I say they will give you a sense of risk diversification against the idiosyncratic risk of China. Of course, even if China, the exchange rate is depreciating very, very fastly, no guarantee, no risk proof for that. But I still say that even if you are to invest in RMB, investing part of that into multilateral institutions bonds will be a better idea. Thank you.
Excellent. So we have gotten to the extra 5 minutes of this conversation. Thank you to all of you, to the Q&A, to the discussant, and last but definitely not least to you, David, for this intervention within this sort of half day of ours. We'll all stay in touch. Hopefully, don't miss if you want to hear about repo markets and how they had influence on liquidity in about 20 minutes or so at a different link, but the next one. And then later on in what is probably going to be like 2.5 hours plus, we're going to then finish our half-day intervention with an historical perspective on CCPs and how a failing CCP in the 1900s had dealt with a liquidity crunch and what that means for today. Thank you, everybody, and talk to you hopefully soon. Bye-bye.
Thank you. See you.
Bye.
Bye-bye. Bye-bye. See you.